Hello, everyone, and welcome to our second quarter 2020 quarterly update. Today, you're going to hear from Roy Williams, John D'Angelo, and Paul Esposito. And as a reminder to everyone, we cannot take any questions during today's live webcast, but if you have any questions, please feel free to email them to pwm@prestigewmg.com, and we'll be sure to follow up. And with that, I'm going to pass it to Roy Williams.
Welcome, everybody. Again, I hope everybody's being safe. To start out, we're going to just look at the numbers in terms of, what the COVID cases have been. Obviously, they're rising and, challenging. Today in the news, Pfizer said they're going to, government gave $1.9 billion to produce 100 million vaccines. Hopefully the vaccine finishes stage 3. But the likelihood is end of the year, next year, we'll have a vaccine. So please, everybody, be safe and practice everything that you can to be safe. With that, let's talk about, John, we talk about this all the time, the number of treatments and, we talked yesterday, there's even an approval, semi-approval, we'll say.
Right, I guess the semi-approval is a vaccine that was approved for the military.
In China.
Moderna, is one of the prominent companies here that is working toward getting, a phase 3 trial started. And you're right, Pfizer is collaborating on a vaccine, and if it's found to be safe, the U.S. is committing to a multi-billion, but potentially a multi-billion-dollar deal to purchase. I wouldn't say what they say, something like 500 million.
100 million initially, I think, for Pfizer.
For Pfizer, yeah.
And with the opportunity, you're right, John, to purchase another 500 or 800 million vaccines. So, again, it's very challenging, and we're going to talk about from an economic standpoint, but the biggest thing is for you and your family to stay safe. If anybody on this call needs any masks or needs sanitizer, we have access. We can tell you where to get it. Please call us. We're happy to help. Paul, let's now get into the economic trends that are happening in terms of, let's look at unemployment and wages.
Right, Roy. I think it's obviously very glaring that we've had probably one of the largest increases in unemployment in Q1 coming into Q2 over the last 50 years, actually stemming all the way back to the Great Depression. Interestingly enough, we are starting to see that rate subside. It did spike all the way up to 16 some odd percent. May's last reading 13%. June's reading, which isn't necessarily captured in Q2, was somewhere around 11%. There are a lot of distortions with this number, given some of the double counting. So it is a number that we are, closely following. But the big takeaway is we've seen an initial jump in unemployment, much like we've seen at the end of past cycles, 08, 09, 2001, 2002. So it is giving us indication that we've ended a cycle. We're in the process of bottoming. What I find very interesting is, maybe a little bit perplexing, is the fact that wage growth for the quarter escalated to well above 6.5%. Which, seems to be a little bit counterintuitive given the fact that unemployment rate is so high. But what it's evident of is that, unfortunately, most of the unemployment is coming from some of the lower paying service-based sector, namely, restaurants and lodging, etc. So the good news is those that do remain employed, there is at least a foundation for, meaningful compensation.
Well, those service jobs that haven't been lost have a greater percentage or greater impact to overall GDP than the jobs that have been lost. Right.
Yeah. One thing, as we work through this, as we see unemployment come down, like today, Nike stock is up because they announced layoffs. And, from personal experience with the three of us, we've seen J&J, AT&T do selective downsizing. So, the good news is that going into this horrible situation, we had unemployment at record lows. So even if we don't go back all the way, if we get back close, we'll be in good shape from an economic standpoint to be able to grow going forward. But this is, $1 million question is how quickly will people get employed, and will company continue to lay off people as we go forward, and how quickly do we get a vaccine? So there's a lot unknown here. So we'll keep everybody posted as we go forward as to what the outlook is. But right now it's getting better, which is, favorable.
Yeah, I mean, but love to see what happens with the airline industry over the course of
right.
a couple
I
of
mean,
years.
Southwest, I think it was 16,000 jobs.
Yeah, they haven't necessarily laid them off yet, but
No.
they're starting to announce what the layoffs are going to look like. So,
So, Roy, just stemming from the theme of, are we seeing signs of bottoming? There's a number of economic indicators that we look at, and there's a few others that we'll take a glimpse at in a minute here. But I think what's very characteristic of this recession is that it's been purely a supply chain driven contraction as opposed to demand driven. If you go all the way back to even the Great Depression, it was really the deterioration of the consumer, maybe by some other measures that caused an economic downturn. This one was caused by us purposely shutting down the economy, and a lot of that is evident in both purchasing manufacturing index and service-based indices as leading indicators. So since we are a service-based economy, as you can see, in the last quarter, we were very, very dismal. A reading below 50 shows contraction. Readings above 50
which means a recession.
Right. Show expansion. So, May's reading for service-based was about 35. Actually, the June reading is all the way back into the mid-40s now. So a very big rebound from the lows. And it just goes to show you that with gradually opening up the economy, this is portending to, service-based activity coming back online faster. The manufacturing end, actually, we're not a predominant manufacturing economy, so it did decline. We did see a similar rebound. These numbers we expect to be choppy given, the recent trend of the Sun Belt, reducing some of its opening plans. But I think the big takeaway from this is we are seeing signs that, maybe some of the worst is past. A lot of that also looks evident in GDP readings. When we look at, this is year over year. Now for 2020, we're probably going to print a contraction for the year of about 5.5%. That's what most economists are projecting. But again, on a year over year basis, very similar to what we saw in 2009 with a rolling 12-month contraction.
Now, John, personal savings, we've seen a huge bump, and I know you've been speaking to clients, who got checks. Most of them didn't spend them.
Right, and I think that is a reflection of the forced shutdowns that we saw nationally where we had the shelter in place. So when you're sheltering in place and the malls are closed and the retail stores are closed and the only place to go is the grocery store, it's almost, I think, a situation where consumers were forced to save capital in some regards because the discretionary spending just disappeared during that time frame. Minus the unemployment, the effects on people's livelihood that came from it, the additional stimulus checks also help.
Yeah. And again, it'll be interesting to see what happens to this number as we go forward the next quarter, to see how much of that money is spent, and if this number declines significantly. Part of the stimulus, and we'll have to see. So there's a lot of parts moving right now. People are unemployed. A majority of people in America were made whole by the extra $600 if they were eligible for it. Between the unemployment and the $600, they were made whole. So they really didn't miss a beat. Now, the end of this month, it goes away. Also, a lot of banks were giving mortgage forgiveness for 3 months, or SBA was doing 6 months of mortgage forgiveness for businesses, commercial real estate. So again, as that goes away, we'll have to see what happens from a savings standpoint and from an economic standpoint. Again, and I can't say this enough, there's a lot of moving parts. No one's going to project this perfectly as to how this is going to end as we go forward, because nobody knows the date of the vaccine. Nobody knows the date of, people getting back to work and the employment, numbers, full employment. So, from a business and consumer confidence standpoint, Paul, why don't we have a discussion here?
Well, I mean, if we look at many of the concerns that businesses had in the first quarter going into the second quarter with capital expenditure, a lot of that was, put on hold, and that's a very logical thing to do if you're a business owner. Again, the trend seems very similar to, 08, 09, where, you had non-residential domestic investment going down in lockstep with small business capital expenditures. For the interim, it does look like we are, again, entering a bottoming process with that contraction. And then, the consumer resonates the same sentiment for bottoming. So you have retail sales, ex-autos in the light blue, and then Conference Board's index of leading economic consumer confidence in the dark blue. They usually tend to move up and down with one another. The reason why, retail sales was exacerbated again, when you shut down an economy and, you force consumers to not be able to spend, it's the reason for such a stark drop. As far as, consumer confidence is concerned, I mean, there are other factors at hand, namely, the buoyancy of capital markets, obviously what the Fed has done, to propagate asset price stability has also fed into greater consumer confidence, but it's a ripple effect, right? If we do encounter, re-shutdown of certain economies, that could very well, funnel into a decline in confidence further. So again, these are numbers that we're looking at, but from at least at this juncture, they're just showing us that we think that we're in a bottoming process.
Yeah, and the bottoming process can take a while. Again, the virus and the vaccine, and the closures.
I think that's a great point. I think if you look at it from an asset standpoint versus an economic standpoint, the real question starts to be, what type of recovery is it? You hear about all these different shapes. Is it a V shape? Is it a U shape? Is it a W? Is it an L? I think, asset prices might be pricing in, a quicker V-shaped recovery. And, that still remains to be seen how the actual recovery plays out, because the virus itself is very unpredictable.
Right. And, that's why I keep repeating, there's a lot of unknowns, and that's why I always tell clients it's based upon your goals. Your portfolio should be based upon your goals. Then you don't get in too much trouble, in these kind of situations. John, you and I were talking earlier about equity valuations and, where we're at. When we look at, before we go into the equity valuations, if you want to sell your home, list it now. We're seeing inventories drop, and we're seeing homes sell throughout the suburbs of New Jersey because people are wanting to move out of the city. It's a reverse before you had everybody moving into the city, now we're seeing people move out of the city. So that's just an aside from, normally recession home prices, go down, and, you have a slowdown here because we're seeing people move to the suburbs, and with interest rates being so low, we're seeing actually real estate pick up and actually do well in most towns throughout the country, cities to suburbs. From Chicago, talking to a client in Chicago, to New York, to wherever we speak to clients, people are moving to the suburbs. We're seeing more and more. But let's look at equity valuations. The three of us were talking about this yesterday, John.
Yeah.
When you look at PE, it's all about what's going to happen going forward.
That's right. Yeah, I mean, when we think of when we think of it from a general standpoint, generally equity valuations look stretched and they look expensive. You dig into the equity markets, what I find is a very, I would call like a bifurcated market. The haves and the have-nots. You have a small subset of what I would call those large mega cap tech companies that have capitalized on this move to digital that was exacerbated by COVID and these stay-at-home orders. And those companies have done very well, and their valuations have got extremely high. And then you have the have-nots, meaning the economically sensitive companies that it's very important for if we get through this bottoming process to thrive, whether it be the airlines or whether it be the industrials, or whether it be banks. And those companies, from a valuation standpoint, their valuations are much more reasonable. So, it'll be interesting to see how the index and how the PE of the index going forward, whether we see a growth into, if Paul talks about this growth into PE over time, where we don't see much volatility, or whether we see some type of a correction, between the summer and maybe the end of the year that, kind of takes care of getting, PEs, I guess you'd say, in a more fairly priced zone.
And again, a lot depends upon the virus and how the openings and closures play out.
Yeah, I think the longer the virus persists, I think the longer you see these mega cap tech companies continue to remain stretched. I almost would think that you'd see potentially a sell-off there.
Yeah, at some point. Again,
rotation.
Rotations happen, but they're also unpredictable as to when they happen.
Agreed. That very well may occur, but I think the 800-pound gorilla in the room that we really need to cite is the influence of both primarily the monetary policy of the Fed and the fiscal policy that's been effectuated, because that has dumped over $5 trillion of liquidity on markets. So when we look at this multiple, right, we look at this trend of a forward multiple trading at 22x, which historically is very expensive, broadly speaking, much higher than where we were at in February. We were at a little over 19 times in February. Part of the rationale behind that is what John alluded to, is that shift in consumer behavior, those adaptations to digital. But more importantly, we were sitting at much higher interest rates back then as opposed to now. The 10-year Treasury all the way back in February was sitting at 1.6%.
It's funny when you say much higher, 1.6% as being high. That's the other five-star tip. I'm sorry to interrupt you, Paul. If anybody in your family wants to refinance, now's the time. Yeah. Can go lower, but I spoke to a client yesterday. He got a 30-year mortgage for less than 2 7/8. I don't know if they put down with a point, but that's a great mortgage rate. So make sure if you have somebody who needs to refinance, do it now.
Right. But where the market stands now, we're looking at a 0.6% interest rate on a 10-year Treasury. So this is really creating a dynamic in the marketplace where investors that have traditionally sought safer returns in fixed income are now moving out And this is, by force of the Fed. This is exactly what the Federal Reserve wants investors to do. Not saying that this is something that every investor should do, but yeah, the dynamic is it's moving investors toward those riskier asset classes, especially when you look at yield comparisons. The bond market in aggregate, is yielding, around 1.25%, compared to what, you can obtain in equity markets. So, there is this, you might hear this on the financial media a lot, the phrase, there is no alternative. Well, we know there is an alternative to investing in bonds. There's different allocations in bonds. But how this is viewed is, investors are looking at stocks in some instances as an alternative to some of those traditional investments.
Well, I think the more important when you bring that up, it's not necessarily retail investors or people who are our clients that may be chasing equity returns. It's the pension funds and it's the large institutions that have to make a certain return over a period of time in order to not be underfunded, that are starting to change their allocations in order to find a greater return than what they would typically get in a traditional fixed income portfolio.
And you got to be just very careful because you need to make sure that your portfolio, and I know I'm repeating myself, is based on your goals, because sometimes you chase yields, if you chase returns, you can get hurt. There's been many periods of times where you got hurt by chasing, higher yields in the marketplace.
Well, I think that's a great point. When you think about a risk, you want to talk about an equity risk. Think about, I heard today that, the FANG stocks represent 50%
of the NASDAQ 100.
Which is unprecedented.
And they've also contributed to over 90% of the return of the entire S&P 500 for the year. So it just goes to show you how bifurcated and how just 6 stocks can lead the market.
In terms of, we spoke about, these are the expectations. Most of this we've hit on. GDP to be negative 6.5% for the year. Again, that number is a fluid number. If we get a vaccine before year end, that could be reduced. Unemployment, 9.3%, which is not good, but it's a significant improvement from where we were in the second quarter. And inflation, obviously, in this kind of environment, is going to be muted. Which that's the expectations. The Fed helped in the last quarter, helped everybody out by going to zero, right, Paul?
That's right, quickly. And, based upon, I know the Fed is traditionally, most of the Fed members release their dot plots. They might actually go, do away with that. But for the time being, the anticipation is that rates are not going to go up for the next 2 years, 2.5 years. So, again, it begs the question, with that in mind, what other policy tools does the Fed, have at hand? They've done a tremendous amount of expanding their balance sheet, and that has really been one of the biggest drivers behind, the recovery in markets, right? So Q1, they dropped rates to zero. That's great. Very similar to what we saw in 2008. But the magnitude of the expansion of their balance sheet via bond purchases, treasuries, mortgage backs, they crossed a lot of lines. They also bought corporates and high yields, which threw everyone for...
Well, I think this chart is highly representative of the amount of liquidity and the amount of debt that has been leveraged in order to support asset prices. And, in this chart, you can see it's really from the financial crisis till today that we've seen this expansion of the balance sheets. This isn't just a yesterday thing.
No, that's
added.
Yeah, and it's important to understand when the Fed is pluses and minuses on a balance sheet. This is a plus on the federal balance sheet. The negative is our debt, which obviously significantly expanded also. So even though we're taking on all this debt, it's not good. but it's not as bad as expectations are because we have a positive on the balance sheet. And the government is providing stability. I just think about the overnight lending market. If it didn't come in and provide stability, we would have had many challenges.
Well, and then with interest rates as low as they are, they're able to finance that debt very cheaply.
Yes. Yeah, and that's the other thing. As debt comes due, the government has 30-year bonds. You think about 30 years ago, interest rates, government bonds, 30-year bonds were 8-9%. Now they're refinancing them at a little more than 1%. So that also helps. In terms of the second half, a lot is going to happen. Around a cure, treatments, corporate earnings, and restarting the economy. You think about the cruise industry. That's probably been the number one stock that people wanted to buy because they get a discount on taking cruises when they can start again.
Carnival
Cruise Lines and Royal Caribbean, those two. But they put off the start, I think, until the end of September now. And again, that's so a lot that will happen in the economy will depend upon when we're able to restart the economy. And you look at New Jersey. New Jersey hasn't. I know of a local restaurant that is closed indefinitely because they can't open indoor dining. And I guess they looked at, their situation and said, okay, let's close until we're able to.
So these regional spikes and these rolling closures are a risk.
Yep. Yeah, and the spikes are happening. Any economy that's open up, that's where you have it spiking. Where you have more exposure to more people, it's a challenge. We have an election coming up, which, as we've seen in the past, John and I were on the phone until, 3, 4 o'clock in the morning last election night.
Almost 4 a.m.
Almost 4 a.m. because of the volatility that was happening overnight. The election, no matter which side of the aisle you're on, can pose volatility.
Yeah, anytime there's uncertainty about policy, that could affect asset prices. You're going to get
volatility.
You're going to get some volatility.
Now, let's look at past bull and bear markets. What stands out here is the length of the bear market and a lot longer bull markets as we go through into the next cycle.
Yeah, I think this is the takeaway here is just to put into perspective for investors, although how sharp declines in bear markets can be, they usually on average tend to be much more short-lived than bull markets. Do we think we're out of the woods yet? It would be one of the shortest bear markets on record, if so, because it's only been about a month, since this bear market's actually been calculated since quarter end, with a 34% decline within that time frame. It very well could, but I think the big takeaway is that once we get past this area of choppiness and we've restructured our economy, that there will be greener pastures ahead.
Yep, and as we've been discussing as a team, right now you have hopium. You have a hope for a cure and hope for treatments and hope for the future. And the biggest thing as you're going forward is to look at what your long-term strategy is. Again, if you have liquidity needs, if you're going to need money to buy another home, or if you don't have enough cash, now's the time to raise your cash levels, meaning if you have a need for it. And again, risk management, we discuss this in our weekly meetings as important to manage your risk based upon your goals and objectives and look at rebalancing opportunities. We want to thank everybody for the opportunity to work with them. And if there's anybody you know that needs help in any way, please have them give us a call. There's a lot of people still losing their jobs. As I said, Nike, we have a client working there, today announced significant layoffs. And we're here for them. Again, if we can be of help to any of our clients with masks or sanitizers or whatever, we'll help direct you to where to get it. And if you can't get it, we'll send you some. So we're here to help you in any way we can. Thank you again for your time.